Feels like there's never been a better time to start investing. Share prices have been coming down over 2022, and we kind of think there are some bargains out there right now. We talked a little bit about what we think might do especially well last time out, but we were thinking, for those people who are kind of thinking, well, okay, now's the time, new year, let's get started with some investing, because there are quite a few people in that sort of camp. What would we kind of say as nice, simple, straightforward advice? We've got 3 each here. Steve, what's your first bit of advice for new investors?
So I guess we're kind of following on from what we've just talked about earlier, and I think my first piece of advice would be, there's a lot of kind of hobbies, and I think investing is somewhat a hobby. Looking into companies and keeping up with them is, I know it's important for your financial life, but you have to be interested in it to do stock picking. But there's a lot of hobbies that you can just dive into. Like there's, if you want to go out and play football, I probably wouldn't recommend you read a book on football. I recommend you get a football and start kicking it about. But I don't think investing is that kind of hobby. I would encourage people to read first, to get a grasp of the market, to understand how markets work, and to understand why people invest in the first place. Maybe the history of the S&P and how it does. And I think that's all really well summarised in The Psychology of Money, which is another plug for Morgan's book. I think that's probably the book now that I would say to people is the one that you should start with. I just think don't dive in. Even though prices are good, I think we're all of the opinion that these prices will either improve or at least stay the same. I don't think this is going to be a quick burn up like we saw in the in the COVID aftermath. So I think you've got time on your side, and I would think to get yourself comfortable first before you jump in would probably be my first piece of advice to new investors.
Yeah, I think there's a lot to be said for getting comfortable. That's connected to my second idea, for what it's worth. But my first one was to keep this sort of stuff in proportion and in perspective. So thinking about how you invest, you can spend ages, and we do on this show, working out what stocks you want to buy, what stocks you want to have at any given moment, and you can go on and on and on like this. But realistically, investing is only a small part of your kind of broad financial outlook and situation and personal setup. So it's absolutely fine to be interested in this stuff and pay attention to it and take it very seriously, because it is serious, right? It's money that is been earned or earned by someone and needs to be looked after, and you're doing this because you want to do well. But making a decision to be invested, I guess, is the most important thing, rather than the specifics of where you get invested. And it's far more important to have the balance right between things like your savings, your spending, your investing, than it is to be invested in sort of specifically the right stocks or the right places, I think. So taking this seriously, but not letting this, staring intently at this one tiny tree and losing sight of the entire forest is, I guess, my first kind of bit of advice.
Yeah, interesting. So, my second sort of piece of advice I would give to people is a broader one. In the last couple of years, we've had kind of a number of get-rich-quick kind of weird schemes that only seem to happen in a bull market. I'm thinking about crypto, but I'm thinking about yield farming and penny stocks, and especially like small Chinese stocks that seem to be IPOing and then going up like 50,000%. And I think my first piece of advice to somebody would be, like, even if you've only got a small amount of capital, I wouldn't think going into penny stocks is the right thing to do. Even if you're planning on starting with 20 quid and you think, I need to have a lot of shares of a company that's not how it works. You really need to get into your mentality that there's absolutely no free lunches in investing. There's no free lunches in finance. If somebody's out there touting a stock that has a tiny market cap, the likelihood is that they've got bags, they want to dump it on you, they want to sell it at a decent price, they're literally going to use you to get that price up, and it becomes a bit of a greater fool theory, which is essentially people keep selling worthless tat to the person who will pay the most until somebody won't pay anymore. So that would be my first piece of advice, would be to first advice for new investors would be to keep keep your head in the sort of mentality of getting rich slowly. I know everybody wants to get rich fast, but unfortunately, the people who try to get rich fast often just get poor fast. So I would look to just to avoid penny stocks and go about it the right way. There's nothing wrong with taking a little bit of risk alongside a balanced portfolio, but you don't want to be putting your whole portfolio into something and losing it all. That is a surefire way to stop investing and have ill thoughts about investing when this is pretty much your fault and not investing's fault.
Yep, seems about right to me. My second one is perhaps characteristic of someone like me. So for my day job, for those of you who know, I teach philosophy at the university, and my second kind of bit of advice for investors is to try and figure out what your kind of investing philosophy is, which is to say try and figure out how you plan to make money. And that can come in a number of different ways, because lots of stock market participants believe in lots of different things, and none of them is intrinsically disreputable from what I can see of it. It's just that they all think about things differently. So I think about someone like Brian Feroldi, who has a load of graphs and charts and stuff that indicate that, look, the companies that go up the most over time are the ones that grow their revenue the most. And that's pretty much the biggest correlation you can find between stock prices and some sort of fundamental. What drives stock prices is revenue growth. You can think he's right about that, wrong about that, but that's what he thinks, and he invests on that basis. You can think about someone like Warren Buffett, who thinks it's about cash flow relative to current price. You can think about people like Paul, not to necessarily put him in the same bracket as those, who thinks that the only real investing comes from getting cash out of a company by dividends or maybe a buyback. I hope I'm not distorting his view too much there, but certainly he puts a heavy emphasis on dividends rather than revenue growth. Which of those is the right way to think about investing? None of them and all of them, from what I can see of it. What matters as an investor is that you have a theory that you think works for you. Because if you have something that you understand and you think, look, this is my way I'm going to make money in this stock market, to be honest, even if it's trading, I don't mind too much. If you really think that, look, I've got convincing evidence, really, really compelling stuff to say that this chart looks like this, therefore this stock is going up, down, or somewhere else, okay, just make sure that's what you believe in. And then when you've got your kind of philosophy here, make sure you stick to it, because it depends a little bit on temperament. Damodaran was saying that if you try and invest like Warren Buffett and you're not Warren Buffett, it's going to go wrong because you're not going to be patient enough. If you try and invest like Brian Feroldi and you're not Brian Feroldi, you're going to get shaken out of things when your stocks come down an awful long way, as they have done over the last year. You will think, but look at all this revenue growth. How come my stock got cut in half? That will happen, and you will need to understand why that's happening, and you need to really believe in the process that you have. So getting a process and a philosophy, which is to say theory of how the stock market works and how investing works, is my kind of second bit of advice. That might take time, but it's worth taking that time, because otherwise you will just be bouncing around buying and selling things at the wrong time, from what I can see of it.
I've always kind of attributed that thought to circle of competence. Mm-hmm. It's kind of like a broader circle of competence. So staying within your circle of competence, are the businesses that you know and can understand is one part of that advice. But the second part is again to stay within your mentality, stay within your circle of competence. If your circle of competence is buying things and holding them forever, then that's the best thing. That's the best thing to do. If you've got the temperament to do that, you'll probably beat us all. Mm. So my last bit is, and again, I feel like I've probably gone for the boring ones, but I'm going to top it off with a third boring one, and it really is about getting your emergency fund in order. I would say at least 3 months of household expenses plus probably discretionary spending before you start investing. Probably aiming to increase that to 6 months. I'm in the Housel camp, where I also think 6 months probably isn't enough, and will continue to put cash away indefinitely as a hedge against the market, because I don't really care about the total return. I'm not looking for the highest return possible. I am looking for a return for my money, but I'm also looking to do it in a safe, secure way that helps me sleep at night as well. So Housel says he basically keeps putting away every month. I started doing that after reading The Psychology of Money. A portion of my money, even though we're already at 6 months, still gets put away and left in cash. Appreciate that isn't the best way of doing things, but it's about what keeps you interested and keeps you motivated and keeps you it lets you have a good night's sleep essentially. So that's one of the things I would do. And there's plenty of good places to put your money away at the moment, Steve. First Direct with a 7% account now. It's gone up again. I think you can put £300 a month into that. If you were looking to build an emergency fund, that would be a really, really good place to do it. Premium bonds now paying out on average about 3.05% as well. So that's pretty good. Still haven't won, Steve. 6 months, still not won. But I'm sure I will do one of these days. But anything you want to add to emergency funds, Steve?
I find emergency funds interesting. They're kind of disappointing or disheartening for new investors in a sense, right? If you sort of see them sat there not really doing anything. I suspect that's easier, by the way, when stock prices are going down and you look at your investing screen and think, well, I'd quite like them to be actually pretty level at the moment and have no prospect of going down. But I kind of think I also go around the 6 month mark for what it's worth. My emergency fund is currently more than 6 months worth of household expenses, only just, but that leads me to wonder, well, okay, so maybe I have an emergency and I need to use part of it. At what point would I want to start topping it up as a point of urgency rather than just ticking it over like I'm currently doing? And I think the answer is if it fell below my estimate of household expenses for 6 months, basically. I would then start thinking, okay, time to rebuild that emergency fund as a matter of priority rather than what I'm currently doing, which is just putting more and more and more in gradually. So, yeah, I think I'm sort of with you on the 6 month bit. I would probably try and get to 6 if I could before I started investing, although I can see the upside to doing it with 3. I feel like seeing it sitting there makes me feel, as you say, it's a sleep at night thing, but it makes me feel quite pleased about things. I sort of think, okay, now I feel kind of bulletproof here, or at least more bulletproof than I would otherwise, right?
That's the idea, and I think we're experiencing it now where we're seeing that there's always a reason that markets go down. It's very rare that they just slip 20% for no reason whatsoever. In the UK, we're experiencing obviously this huge squeeze in energy bills, inflation, blah 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 blah, and it's not affecting me in a way that I'm thinking, oh, I'm going to have to sell some stock. I'm going to have to sell some stock to pay my gas bill, this month. If worst came to worst, I would have to sell some premium bonds, which it's not really a problem for me considering I haven't won for 6 months, so it's not going to affect me in any way, shape or form. Yep. So that's the idea of an emergency fund. It isn't necessarily that you would have to, you're anticipating emergency. It's that if an emergency does happen, you don't have to sell your stocks at the worst possible point to realise some cash and get yourself out of a hole, and that is probably invaluable.
Yeah, it's interesting. One of the things I've been thinking about recently, where I've been thinking about stocks and investing and actually mortgages and house prices, I've been thinking, look, when we look at companies that we're wanting to buy, we look at their balance sheet and we like to see their balance sheet is strong. We don't like to see huge amounts of debt on them or more debt than we think can be generated in cash and so on. And it feels to me like, what is the point of buying a company that has a strong balance sheet if your own personal one is a mess because you haven't got enough cash on it, basically? Sooner or later, that just means that you've got yourself into a tangle and the company you own isn't in good shape. But that seems about as risky as buying a company, having your own personal balance sheet be strong and buying a company with a terrible one. It feels like turning your own one into a weakness to buy something with a strength doesn't seem to me to be a particularly smart idea.
Yeah, and you've got to remember as well, during the bull run and the low interest rates, there was a couple of YouTubers who will remain unnamed who reckoned that emergency funds were essentially a drag on returns. Now, whilst that is true, they were claiming that you could take debt out instead, obviously because debt back then was super cheap should you need it. The unfortunate thing is now that the crap has hit the fans. Debt isn't cheap anymore, and some people will have followed that advice and chucked money into the market, which is probably now 70% less than it was, probably because they're Tesla shareholders, and yeah, now they're sort of like they could potentially be in a pretty rough place. So that's why I ignore that kind of rhetoric really, and I'm more interested in keeping my emergency fund essentially where it is.
Yeah, here is my third bit of advice. It's also on the subject of useless things that other people offer. I won't mention any YouTubers either, but I could. And I could also mention people on Instagram and so on. But here's something that I think that new investors ought to be very careful of. It's people and systems and styles of investing and approaches, and usually things that are paid for in this situation, but they don't have to be. They're equally as bad if they're free. Where what you do more or less is read off 8 to 10 numbers from some company's financial statements, plug them all into a thing, and then it tells you whether or not something is a buy. That is a pretty horrific way of going about investing from what I can see of it. So here's a quote from Charlie Munger. It says, when you're trying to determine something like intrinsic value and margin of safety and so on, there's no one easy method that could be simply mechanically applied by, say, a computer and make anybody who could punch the buttons rich. I love this quote for what it's worth, because it kind of infuriates me when people just say, look at this number, look at this number, look at this number, look at this number's bigger than this number, and this number is higher than that number, and this number over that number is less than 2, so this stock is a buy. I'm not saying those are not part of a story, by the way. You absolutely want to pay attention to a whole bunch of numbers when you invest. And I'm not going to tell you which ones you should or shouldn't look at. It's entirely up to you to figure it out. See part 2 of my kind of advice. But what I do think is that you should be extremely wary of anyone who says, yeah, look at these numbers, therefore the thing is a buy. This can lead you into all kinds of things. It can lead you into buying companies that have just had sudden changes in their future. It can lead you into companies that are have been struggling before. It can lead you into basically cyclicality issues, because if you look at what's been going on recently and have no sense of what a company does or why it specifically is going to do well in the future and why those numbers are going to go up, down or sideways and looking ahead, that's going to go wrong as often as it goes right, and you're not going to understand why, because your wonderful formula, which just said, but this number and this number and this number, isn't going to provide you with any kind of answers or any kind of understanding. It will work some of the time. Anything will work some of the time. Chucking darts at the S&P 500 will work some of the time. Will it work often or reliably or anything like that? Not by itself, it won't. Not saying this isn't part of the story. You absolutely want to be attentive to some numbers here. But you really need to understand companies, how they work, what it is about them in qualitative terms that justifies these numbers that you're sticking in some cases, and not just because it's a little number.
Yeah, and we've had this conversation before, Steve. There's a couple of times we've looked at things like discount cash flow calculations, which are on fancy websites, and we thought that potentially people are putting in the wrong numbers, and they're putting in the wrong numbers to spit out a wrong number at the bottom, because it's kind of a I guess it's a bit of a circle jerk between the watchers and the host to say, look at how wildly overvalued it is. I've put these numbers in and they're completely right. And look, even if I change the numbers and leave the PE at 6, it still comes out really less than what the share price is. And some of those people feel vindicated at the moment because share prices are coming down, but they're not coming down for the reasons that they're saying, because sales are still pretty strong at some of these companies. But I sent you a bit of information from Quarter, Steve, a couple of days ago, just with some 15-year revenue growth on there.
Yep.
And that was really interesting to this sort of broader discussion. And we were looking at companies that have grown at a sort of exponential rates for 15 years, which you almost never see in these discount cash flow calculators. They always kind of tail off after 10. And, you know, some of them, they only have 5 years of growth. But I was looking at companies like Dexcom. For 15 years, Steve, it has grown at an average of 53% on the top line. But it's not just things like Dexcom. CRM has grown, which is Salesforce, has grown at 28%. Amazon has grown at 27%. This is 15 years of growth. LSEG, London Stock Exchange Group, has grown at 24%. Google at 21%. Intercontinental Exchanges, which is that's the NASDAQ. That's the NYSE, isn't it?
Yep.
If I remember correctly. That's 21%. Apple at 20%. Illumina, which is a stock that we both liked a couple of years ago, I think, has grown at 19%. These are incredibly fast revenue growth rates. So I only wanted to add this in, and I'm sorry, I've kind of blindsided Steve with this because I didn't tell him that we'd talk about this beforehand. But this just proves to you that even when you put in conservative numbers into a spreadsheet and say that it has a terminal value of an indefinite growth of 2% from that point onwards, excellent companies grow at excellent rates for very, very long periods of time. And that's what I would sort of like add on to your bit, is that get yourself a discount cash flow calculator and by all means have a play with it. But you've got to make sure you're putting the right numbers in, because you could miss the opportunity of a lifetime.
Yeah, do it properly, basically, is what we're suggesting here, I guess. If you're going to write estimates for things in, make sure they're actual estimates. So just be clear about what estimating here means. It means guessing at something, and guessing is an activity that succeeds when it's accurate, not when it's under something. So if Steve and I stand next to a motorway and watch a load of cars come past, and he estimates that there were 74 cars, and I estimate that there were 100 cars, his isn't more right because his number is lower. It depends on how many cars there actually were that came past. If there were 98 cars coming past, my estimate is better because it's closer. If there were 76 cars, then his estimate is better because it's closer. Better estimates aren't always lower estimates. And it's easy to get suckered into thinking, well, look, I need this thing called a margin of safety. Therefore, my actual estimate is this. Therefore, I'm going to write a number that's half that for no reason other than a margin of safety in some fashion. That's not what a margin of safety is. So one thing to get clear on before you go about thinking in these kind of things.
Yeah, and you've also got to be careful if you're taking a growth rate that's existed for a long period of time and you're adding maybe you put half of that growth rate in to be conservative and then adding a margin of safety at the end of that. What you've essentially done is built in two margins of safety. You haven't got your original 10% margin of safety. You've got 50% at the beginning and 10% at the end. So what you're building in there, you'll probably end up with a number that you'll think, whoa, it's nowhere near that. But that is kind of how these discount cash flow calculators work. They're oversimplified to the point where they're almost useless unless you can find a way of getting accurate numbers into it.
And that brings us back to kind of what this bit of advice was, really. So it's not a case of investing is about writing implausibly low numbers and then complaining everything is overvalued. Take it seriously, do it properly, right? It's not just about trying to convince yourself that something is overpriced and then claiming you don't understand it. If you really don't understand a stock, that is absolutely fine. And there are stocks that it's perfectly possible that a stock is glaringly overpriced. Steve and I can tell you ones that we think are overpriced right now. But things aren't overpriced because you deliberately wrote the wrong numbers into a spreadsheet and then a number came out lower than the share price. So be careful of anything kind of leading you in that sort of direction. That's a long way further down the line for anyone trying to start out picking stocks or anything like that. But it's something to be aware of, and it's something I've noticed a fair bit lately. And I suspect it's something we're going to see quite a lot more of in 2023 if I'm right in thinking that there's going to be a recession and that growth stocks are going to struggle.